Okay, great. Good afternoon, everyone. This is Andy Kaiser, the Kaiser Law Firm, and thanks for joining us this afternoon on what hopefully is now going to be a clearing day here in St. Louis. A lot of rain, as I was telling Evan, as he is in Virginia. So hopefully we have some sunshine coming up. Really glad that you guys are joining us today. I think you're going to get some really great information here from Evan, and I wanted to really just introduce Evan at this point in time. And obviously, you're here to learn about the topic that we sent out about charitable remainder trusts and how they can be used as an alternative for the stretch IRA distribution since the Secure Act. I met Evan actually taking a webinar last year, and I thought he did an amazing job, really explained things really well. And immediately after his webinar, I followed up with him. And after learning so many things from him, starting to work with him, and he helped several of our clients over this last year implement some of the strategies using a charitable remainder trust. And so I thought this would be a valuable tool to share with our client base and other people that we work with as something that you could get a lot of value out of. And so by way of background, Evan is the owner of CRT Experts that he founded, CEO. He's had over, I believe, 20 years of experience, and this is his business is working with other advisors like myself and helping their clients establish charitable remainder trusts for different various reasons. He not only helps at the very forefront in the design, but he also works there side by side with the advisor to help administer a charitable remainder trust once it's in existence. And then Evan's been doing this such a long time that there's many charitable remainder trusts out there that for one reason or another, the income beneficiaries may want to exit from the charitable remainder trust. So he does work in that space. And I will certainly turn it over to Evan and let him fill you in a little bit more about that. But and we'll also save some time afterwards to answer any questions that you may have. And I think Evan said he'll be recording the webinar as well. So if anybody would like to watch a recording, I think that should be available. So I will stop talking and turn it over to Evan and let him run with the show. Thanks, Evan.
Yeah, sure. Thank you, Andy. It's great to be here. I appreciate the opportunity to talk about using a charitable remainder trust as a stretch IRA substitute. So as Andy mentioned, I've spent and the team here, several of us, we've spent our entire professional lives working with charitable remainder trusts. So we run the gamut. We work a lot with creating and designing CRTs. We'll talk about that, of course, a fair amount today. We administer CRTs. We get involved later in the life cycle, and we always work through advisors. So we do not manage assets. We don't give tax or legal advice. So CPAs, financial advisors, and attorneys are where most of our business is referral driven through those professional advisors. So Andy, you've got my screen, right? So screen share's on.
Yeah.
Okay. All right. So just here at the outset, just a quick overview. Obviously, we're here to talk about the fact that the Secure Act ended the stretch IRA, how to use a charitable remainder trust to replace that stretch. We'll go through the basics, how it works, when and how the planning is implemented. Who's a fit, who's not a fit, etc. But then we'll also go beyond the basics, and we'll think about, okay, we've made the decision. Yeah, we'd like to use a charitable remainder trust, a CRT, to replace the stretch. But as we'll see today, not all CRTs are created equal, and there are ways to structure CRTs to maximize the value, the after-tax value for the beneficiaries. In this context, it's usually kids and grandkids, and we'll talk about our views on how to properly structure the charitable remainder trust. We'll use an example to look at some of the design features of a CRT, and we'll at the same time we'll look at a comparison of a family who uses the CRT to replace the stretch and a family who does not, who just allows the children to take the income from the IRA during that 10-year period. So the problem, of course, is that the Secure Act ended the stretch IRA. So instead of the IRA upon the owner's death going to the children and being able to stretch that or to the beneficiaries over the beneficiaries' remaining lifetimes, the Secure Act pushed that all the way down to 10 years. And so because of the way that those distributions are taxed, they're taxed at the highest applicable tax rate. That creates whatever you want to call it, a tax disaster, as we hear of it called a lot. We look at it. It's effectively a large tax on the IRA after the death of the IRA owner. But however you want to describe it, for many people who have CRTs, it creates a problem. And these are people who have IRAs or retirement plans, people who had planned on allowing heirs to take that income over their remaining lifetimes and stretch that out. That creates a problem. Fortunately, the charitable remainder trust creates or represents a pretty natural solution, and that's what we'll talk about here today. So when we think about an IRA, a 401k, any retirement plan, really at the core of it is tax efficiency. Tax efficiency is what's driving the value of the IRA. We're investing pre-tax dollars in a tax-free account. And even though the Secure Act ended the stretch IRA so that the IRA can't be stretched beyond 10 years, what we're able to do with the charitable remainder trust is replace that tax exempt environment. So the IRA, it's exempt. It's able to grow the assets tax-free. As soon as within that 10-year window, if we don't do something, what happens is that in that 10-year window, it has to fully be distributed out, all at the highest possible tax rate. A CRT is an exempt trust. The charitable remainder trust itself is exempt, just like the IRA. So what we're able to do is upon the IRA owner's death, is those assets from the IRA drop into the charitable remainder trust, which is exempt. So we're keeping those assets in that tax-free environment. And that's, of course, the power of the IRA. What the IRA was doing, the CRT is able to do the same thing, keep those assets in that tax-free environment. The investment advisor then has the benefit of being able to grow those assets tax-free. There's no tax drag moving forward, as long as those assets are in that charitable remainder trust. Like an IRA, the distributions from the CRT, the charitable remainder trust, are taxable. But the taxation is a little bit different. So with an IRA, we know that distributions coming out are all going to be ordinary income. The way that the distributions from a CRT are taxed, so they're taxed according to a tiered accounting structure. Yes, the ordinary income has to be distributed out first, but once all that ordinary income is distributed, the trust can start distributing capital gain and then tax-exempt income and eventually corpus. So eventually what that means is, we'll look at our example later where we have $1 million IRA. The IRA owner passes away. That $1 million IRA goes into a charitable remainder trust. It's still exempt, still growing everything tax-free. The first $1 million of income that's distributed out, that would be ordinary income. But as long as that CRT is invested for capital appreciation, which it would be, after that $1 million of income is distributed, and we're usually looking about 15 years out on the duration of the CRT. After that, a lot of the income is capital gain. So actually, over the long haul, we actually have some tax advantages down the road with the CRT, even compared to the old the stretch IRA. I mean, that's not possible anymore, but with the stretch IRA, we were stretching out over lifetimes, but it was all ordinary income. With the CRT, we're still stretching over lifetimes, in many cases more than one generation, as we'll talk about, but we're eventually able to distribute that income at the capital gain rate. So we're garnering some additional tax advantages down the road with the CRT. From a tax and legal standpoint, pretty straightforward here. CRTs have been named beneficiaries of the IRAs for many years, well before the Secure Act, much more frequently now because of the Secure Act ending the stretch IRAs. But you can see up there on the screen, during the 1990s, there were several private letter rulings that confirm that a qualified trust like a CRT can be the beneficiary of a qualified plan. And of course, we know that once those assets are inside of a CRT, the CRT is exempt from tax. So what we've been able to do here is with the CRT is restore the stretch. The CRT is preserving the pre-tax dollars in a tax-free account. The trust is growing tax-free under Section 664 of the Internal Revenue Code. So Section 664 is what created charitable remainder trusts. That's what gives the ability to grow these inside this tax-free environment. And we'll talk about 664 quite a bit later, because that's where all this flexibility is that we encourage using with charitable remainder trusts. So at the end of the day, we've restored the stretch. The heirs are getting significantly more money. We'll look at an example here to see how much more. But I will say that the lens through which this decision is made is not as numerical as many decisions. In many cases, it's when we're making financial decisions, it's usually what creates the best after-tax result, what's creating the most after-tax value. In this case, it's not always purely just dollars and cents. What it often comes down to is some families, some are going to say, we're fine. They probably weren't using the stretch IRA to begin with, but we're fine letting our kids take that IRA, all those assets inside of that 10-year window, regardless of the tax consequences. We could sit here and demonstrate that, well, but if you stretch it, whether it's the old stretch IRA or now using a charitable remainder trust, you're creating so much more after-tax value, double, triple, quadruple more in after-tax income for your heirs. That's some clients, that's just not the goal. What they want to do is just let the kids have it as soon as possible. But for clients who are looking to restore the stretch, to stretch that income out over the kids' lifetimes, that's where the CRT is really this natural solution. There are some other advantages with using a charitable remainder trust. We'll see we can get multiple generations onto these CRTs. Most times the CRT should be going 50 to 60 years in terms of the expected duration. There's asset protection benefits from using the CRT. One of the key things that we emphasize is if we're using a revocable trust to implement the planning, this can flex over the IRA owner's remaining lifetime. So we put this in place now. And as we'll talk about, we have to do it now. We can't wait. This cannot be done on a testamentary basis. But the planning can be adjusted. It can be fully undone if it's just we've changed our mind, we don't want to do it anymore. Or if grandchildren are born, we want to add beneficiaries, we can add them. If we want to subtract them, we could subtract them. So it's fully flexible until the IRA owner passes and the assets from the IRA drop into the charitable remainder trust. The effective date of the CRT is when it takes in those IRA assets. So who's a fit, who's not a fit? Because we're using a charitable remainder trust, we do have an asset threshold. It's usually about $500,000 in terms of where does this become viable from a financial standpoint. A CRT is its own entity. It's a standalone entity. So it has its own tax ID number, and it does require trust administration. It's not overly expensive. It's $2,500 or so a year to administer the trust, but it does require administration. So if we have $50,000, $2,500 a year is going to chew up that trust pretty quickly. So we usually, again, we'll generally, as a rule of thumb, say, we need to have $500,000-ish in current or expected retirement plan assets. Of course, we're thinking about this as we get older. So if we're thinking about who's a candidate here, who should be looking at this, it's anyone with one of these retirement plans, age 50 plus, and 500,000 or more in current or expected retirement plan assets, and obviously interested in maximizing after-tax value for the kids. Who isn't the candidate? It's the candidate that I mentioned a little bit earlier. It's the client that says, or the IRA owner who says, I'm fine I get that, with 10 years, this is going to be highly taxable income to the kids, but if they want to take it all, well, they have to take it within the 10 years. A lot of kids are going to take it all in year one. We're fine with that. Obviously, they're not going to be a good, that profile is not going to be a good fit for what we're talking about here today. So we talk about implementing, just there's two key points. The second point we'll get kind of bridge into the back half of the discussion, really looking at the CRT design. But the first point is we've got to do something now. We cannot wait until that IRA owner is passed. At that point, it would be too late. So we'll talk on the next slide about the different ways to implement this planning. The key thing to note, though, is it's got to be done ideally sooner rather than later, but it certainly has to be done before death. So how do we implement the planning? There's three main ways it's done, and the testamentary trust is the most common, and we'll go through why. The three ways are a funded CRT, an unfunded CRT, and a testamentary trust. So in each of these cases, the result is the same. The trust, the CRT, the trust is named the beneficiary of the IRA. So we're going to go to the custodian of the IRA, fill out a change of beneficiary form, and name the CRT as the beneficiary of the IRA. If we're using a funded CRT, and could be an existing CRT, or CRT we might set up and we're using it to take in some appreciated real estate or something like that, and then we also want to name it as the beneficiary of the IRA. Most CRTs that are outstanding today, they're existing, will have language in the trust that will allow for future contributions. And so as long as the trust has that language in the trust instrument, the trust agreement, we can then name that CRT as the beneficiary of the IRA. We don't see unfunded CRTs as much used, but it is an option. So we can create the CRT now, fund it nominally. And these are qualified trusts as far as state statutes go, but under federal statutes, there's no requirement for administration if we're funding it with $100 or $200 or whatever. So that makes it doable. Obviously, if we have $100 in a trust and we're paying a couple $1,000s a year for administration, that's not going to work. But until it's fully funded from the IRA, from the IRA upon the IRA owner's death, we're not required to do administration because it's only funded nominally. The big drawback here is it's irrevocable. So we've made the effective date of the CRT today. Even though we funded it nominally, it's irrevocable. We can't make the changes. And that gets to the third option, and this is what we see utilized most often. It's what we would recommend, is to do the planning through a revocable trust or a will. So we're gonna sit down today and figure out, okay, let's structure this CRT based on our situation today, and we'll talk about what that means in terms of who we want to receive the income from the trust, what type of a trust do we want it to be, payout rates, etc. And then, but doing it through a revocable trust or a will, that will allow, if you 5 years later, if you want to make some adjustments, you can go to Andy and make the adjustments. It's everything we can, until the IRA, the way that the trust is written, the effective date of the trust isn't until it's funded with the retirement plan with that IRA. Until that occurs, which means we will have passed, the IRA owner has passed away, that's flexible. So we can make changes, including undo it if we want, up until that point of time. So it's the easiest option. It's also would make the most sense just from a flexibility standpoint, making sure that everything's revocable until we've passed away. Okay, so we've made the decision now. We were going to use the stretch IRA. We can't do that anymore. The CRT is a great solution. We've decided to move forward, and this is where the team at CRT Experts, we can provide a lot of insight. We've looked at almost 10,000 CRTs over the last 25 years now. And in looking at that many CRTs, we've just seen the good, the bad, and the ugly. And when it comes to the bad and the ugly, so much of it is always rooted in flexibility that wasn't given up front when that trust was designed, but had the client, the donor, been made aware of that flexibility, they would have done it. And that obviously is frustrating. There's a lot of different things we can do under Section 664 of the Internal Revenue Code when we're creating CRTs. And so what we can do is we want to take advantages of much of that flexibility as we can when we're creating the trust. Once the trust is created, it is an irrevocable trust. We can't undo it. We can't change the terms. So what we want to do is provide as much flexibility as we can. We'll talk a lot about, for the remainder of the presentation, the first two bullets that you see here on the screen, duration and deferral. But when creating a CRT, we want to think about all the components. Basically, if Section 664 allows for flexibility with respect to any aspect of the trust, we'll discuss it with the family and build in the desired amount of flexibility. So as you see up here on the screen, there's we'll go through duration and deferral, but trusteeship. Most CRTs, they're what are called self-trusteed. And what that means is if I'm the donor and the income beneficiary, I'm the trustee. That's the way to go in most cases. There's no need for an expensive corporate trustee for a CRT. But this is, most trusts that are out there today, and the Secure Act is changing this, are what are called self-settled, meaning I'm the donor and I'm also the income beneficiary. In this context, when the IRA owner has passed, now the donor of the trust is not the income beneficiary. So in some cases, we will see that the parents who create the CRT with the IRA, they'll want to put some guardrails, so to speak, in place. So they may want their financial advisor to be the trustee. The trustee with the CRT is that's who's responsible for the administration of the trust, the investment management. That's who's responsible for making the distributions annually. So trusteeship, we want to think about the charitable beneficiary. Some parents who are setting these up, they're fine also giving their children the ability to adjust the remainder beneficiary of the trust. So with the CRT, everything goes into the CRT that pays income to the income beneficiaries for their remaining lifetimes. Whatever's left will go to charity. And so some clients will want to, I'm going to set this up. My kids are going to receive the income, but I want the remainder to go to my alma mater. And I don't want that to change. Many parents who set these up, though, are fine allowing their kids to adjust the remainder beneficiary. It's purely a client preference. If you have a donor advised fund, that is a permissible beneficiary. So we see that a lot, is the remainder beneficiary of the charitable remainder trust. In most cases has to be a public charity, but a donor advised fund qualifies. So in a lot of cases, this will end up paying children and grandchildren. And then at the end of a term for the grandchildren, it'll pour into the donor advised fund. And then the grandkids will give the money away out of the donor advised fund. And that's a scenario that we'll look at here when we see our comparison. So to set the stage here for the comparison, and we've got two families here. Family B is creating the CRT. We're going to use their CRT to look at not only the comparison from a financial standpoint, to look at the difference between using a CRT to replace the stretch and not, but we'll also look at that CRT. We'll use that CRT to look at some of these design features, duration and deferral that we're talking about here as well. So these families are identical. They're each putting $1 million from an IRA into a CRT. The only difference is family A is going to allow the children, they're not using the CRT. The children are just going to withdraw the money from the CRT over a 10-year period. And family B is going to use the CRT to replace the stretch. That $1 million will go into the CRT. And of course, that goes into the CRT with free of any taxes. So that full $1 million is now in that tax exempt trust. We've maintained those tax-free dollars in that tax exempt environment. The CRT is invested. And here we're going to look at what I would usually call a two generation plus or three generation. It's a two generation lifetime plus a term to the third generation. This is how many of these are going to be structured, where we have, in most cases, well, for all the males out there, unfortunately, we're life expectancy wise, we're going to predecease our spouses in most cases. So in terms of just what do we see most often, the male will pass away, the IRA owner, the IRA will then drop into the CRT. The spouse, in this case, the wife, is the initial lifetime income beneficiary of the CRT. In a lot of cases, the spouse isn't going to take any distributions. The spouse can, but a lot of the families that we work with who are implementing these, the spouse doesn't want that taxable income. And if the spouse, and we'll see this, if the spouse defers income, that's just going to allow that the trust to keep growing tax-free, and it's just going to create more income for the kids and grandkids. But in this case, we're going to assume the spouse takes the distributions. So we've got a 5% payout rate. CRTs can have a payout rate anywhere between 5 and 50%. We're going to use 5%, and we'll see why later. That's what allows us to include that third generation, those grandkids as term beneficiaries. So we've got the spouse as the initial income beneficiary. We've got 2 kids here, and once the spouse passes, the CRT income, that 5% annual distribution, will continue to the 2 children until the last of their deaths, and then it will continue to the grandchildren for a fixed term of years. And that fixed term of years depends on what's called the 10% remainder test. That's a calculation done up front. We'll hit on that a little bit. But high level here, what's happening is that full $1 million, no income tax is going into the CRT. That's paying 5% annually, initially to the spouse for the spouse's remaining lifetime, then to the 2 children for their remaining lifetimes, and then to the grandchildren for a fixed term of years. Now, what if we have 3 kids or 4 kids? All we would do there, it's not a problem. We would just use multiple CRTs. As long as we're using all this, the multiple CRTs are administered by a single administrator, it's not going to cost any more to administer those multiple CRTs. And that will allow us then, because we're using multiple CRTs, to get the full duration, to include as many of these family members as we can. So if we had more time, but we talk about the app. We wish at CRT experts that the decision was solely made based on what creates the most after-tax value. So this really is not a fair comparison. You've got this immediate tax hit for family A on this IRA, that's $1 million. It's got to be distributed over 10 years, within 10 years, and it's at the highest applicable tax rate, versus dropping that $1 million and keeping that in the CRT, that tax-free environment. That's not a fair comparison. And you can see here about 3.6 million in income for family B, where it's 1.6 million for family A. As I mentioned earlier, many people who are in family A situation are fine with that. They want to give the kids the ability to get all that income regardless of the tax cost. So we would typically just go through this and we would build up to this. We would look at these charts individually, but in the interest of time here, I'm just going to overlay them and I'll just walk through what this chart is representing. But we can see let's see if I get my laser here. We can see the results right here. 3.586, 3,586,000 to be using that CRT, and 1,614,000 to family A. So what's going on in this chart? This right here is the CRT, the green line. So that $1 million drops into the CRT from the retirement plan, goes into the CRT. we're assuming equal growth, 7% in the CRT, 7% with the IRA distributions. So the CRT is invested. Our 5% distribution comes out each year. That's the green vertical bar. And then the solid red line here, that's the IRA. We've got to spend that. We've got to distribute it all out within the 10 years. So we just distribute it out evenly over the 10 years. The dotted, we then take the distributions from the IRA, we reinvest them, but we need to distribute out to keep it apples to apples. We're going to distribute out the same amount of income that the CRT is distributing. So early on here, the kids are the beneficiaries of the IRA are getting without the CRT that are taking it during the 10 years, they're getting just as much income as they would have been getting from the CRT. But of course, the IRA scenario, we're going to run out of money because the immediate tax hit on the IRA is just too much for that strategy to overcome when we're comparing it to the CRT that's keeping everything in that tax-free environment. So you can see sort of that break-even point here is out here about 30, 35 years out. Of course, we're into the kids' lifetimes now. They would have run out of money. They've got $1,614,000 with that without using the CRT. The CRT though is going to keep on going and keep on paying, and so that's getting out here to north of almost 3.6 million. So this is very typical in terms of how the numbers will look. Again, it's not solely made through a numerical exercise. We wish it was, but it certainly if the decision is going to come down to that, it's going to favor the CRT because of the tax advantages. So when we're structuring a CRT, when we're thinking about duration, so how long that CRT is going to last, what we're trying to do is we want to maximize the duration. And what that means is we want that trust to pay out for as long as possible. And we want to include as many family members as we can. And so as many generations as we can. So we're going to look at, you can see the ages up here on the screen of our family B. Our surviving spouse, she's 84. Children are 59 and 56, and we can see the ages of the term beneficiaries. So the way that this will work in practice is there's software that we use. So this is where we're going to get to that 10% remainder test. The way that the rules for CRTs work is that 10% of what is donated to the trust, in this case, this $1 million IRA, 10% of that on a present value basis needs to go to charity. Doesn't mean that actually has to happen. So if the trust pays 0 to charity or it pays, $500,000, nothing matters in the future in terms of what's actually paid to charity. It's just a calculation that the IRS does up front to determine how long we can stretch that trust out, how high we can take the payout rate. We're always going to be limited by what's called the 10% remainder test. So what we're going to do when we're designing these CRTs is we're going to load into our software. You can see everyone's age here. So we have the spouse is 84, the 2 kids right here. These are lifetime beneficiaries. And then the grandkids are going to be term beneficiaries. With the last of their children to pass, the grandkids will then receive the income for a fixed term of years. Maximum is 20. So we'll start at 20 and then we'll just start reducing it until we pass the 10% remainder test. In this case, it's about 18 years. So for this family, what they can do is structure the CRT so it pays the spouse, the wife, 5% for her remaining lifetime. Then it'll pay the 2 kids 5% in equal shares for their remaining lifetimes. And then it will pay the grandkids in equal shares for an 18-year term. So the second part of the CRT design that is in our view wildly underutilized is deferral. And so there's different types of charitable remainder trusts that are possible. One is called a CRT, or charitable remainder annuity trust, that pays a fixed dollar amount. Those are not common. About 90% of the CRTs out there are unit trusts, meaning they'll pay a fixed percentage. In our example here, 5%. There's two types of unit trusts. There's a standard CRT, which will pay that 5% every year, no matter what. The trust can make money, lose money, doesn't matter. It's going to pay 5%. Then there's another type of a unit trust called a net income with makeup. It's commonly referred to as a NIM CRT. And this NIM CRT, if structured properly, will allow for deferral. So in many cases, what we see here is that, and I mentioned this earlier, the spouse in this scenario doesn't want the income, doesn't need it, doesn't want it. And so what the NIM CRT will allow that the spouse to do is defer income. So we can put this, in this case, we have our 84-year-old spouse, we're expecting she'll live 10 years. So we have a 10-year period where that trust is just growing tax-free. And obviously what that will do is it's going to augment the income that's eventually paid to the children and grandchildren. And we'll look at just by how much the income is increasing here in a second. The NIM CRT achieving deferral from your standpoint, that's Andy's job. That's our job, is to set this up and make sure everything's structured properly. If you're interested in that discussion, or if you're just having trouble going to sleep one night, I put the link up there for a webinar where I do a deep dive on how that works. There's different ways to do it, and we go through those in some detail on a webinar we did for attorneys like Andy. It's not necessary for the donors to understand, but if you're interested, you can check that out. So let's now look at the same CRT, the same map here of the CRT, except that spouse right here is going to defer income. So let's look at what sort of a difference that will make here. So you can see no change for family A, but family B now is up to 5.2, north of 5.2 in income. Remember, they were at 3.586. So we can go from 3.6 to 5.2 in total income using that deferral period. So this is where the spouse doesn't want the income, just allows the trust to keep those distributions. Everything's growing tax-free. It really just turbocharges the income of the CRT. You put something in deferral that's tax exempt for 10 years, you get all that tax-free compounding up front. It allows that CRT to grow up much, the growth of the CRT, you see that grows much quicker because it's not having to make those distributions. And that's what allows for more income to be distributed out here to the kids and grandkids, the successor income beneficiaries of the CRT. Okay, so before we open it up for Q&A and wrap up here, just to put a bow on our discussion here, what we're doing is we're using a charitable remainder trust to restore the stretch. We're preserving the IRA, that's tax-free, but the owner has died. We're then moving the assets into another tax-exempt environment, the charitable remainder trust, and we're using that to distribute income, in our case that we've seen here, for multiple generations, but certainly restoring the stretch over the remaining lifetimes of the spouse and children. So this is an effective way if you're looking for a way to restore the stretch that the Secure Act took away. Get in touch with Andy and have him take a look at a charitable remainder trust for you. Again, everything can be done on a revocable basis using that testamentary trust or that living trust or will. So everything can be done in such a way that until your death, it can be changed, undone. So you've got that flexibility as well.
Right. Well, this is great, Evan. Thank you so much. I can't tell by looking at my screen if there's any questions for the people in the audience yet, but thought you did a great job as usual. And certainly we're here for everybody here if they have any follow-up questions, if afterwards they want to ask as well.
Don't Let me just check here. I don't think so. Doesn't look like it. So
Okay.
up, we've got. Looks like we had one hand raised. I think you can just hit raise your hand if you do have a question. My contact information I'll put here at the end, but if anyone has any questions, just let Andy know, and then we'll get those answered. He'll get those to me, and he'll answer those. Okay, we do have a question here. Oh, a couple of them. So this one's from Dawn. Grandkids get the money over their lifetimes or fixed term. Uh, Fixed term in our scenario here. So again, we're back to that 10% test. So if there would be a way, so if we could set up the CRT however we want. So if we wanted this to go directly to the grandkids, what we would tell Andy when he's drafting the trust here is to put the grandchildren on as the immediate lifetime beneficiaries. Still depends on ages, but right now, if they're in their early to mid 30s, they can be the lifetime income beneficiary and still pass that 10% remainder test. So we couldn't set it up to go to the kids and then the grandkids for their lifetimes unless the grandkids, I mean, I've never seen that just based on actuarials. But if the goal was, the kids are successful in their own right, they're not going to want this income, we'd rather it go directly to the grandchildren. Yes, they could be lifetime beneficiaries. What we looked at today, though, is more common, where we'll see it go to the children first, and then at the end of the children's lifetimes, it will go to a successor term, and that is limited to 20 years. So we would certainly look at trying to get it as long as we can. If the goal was grandkids only, we might be able to do it. It would just depend on everyone's age. Tony, does the beneficiary always need to be immediate family? No. The beneficiary can be anyone, as long as they're living at the time of the trust is created and known. So it can be anyone. It can be nieces, nephews, friends, anyone. An entity can actually create a CRT. We're asked a lot about S corp. Can an S corp? We can't have an S corp. We don't want to donate S corp stock to a CRT, but an S corp can create a CRT. The only difference, though, is when we have a non-natural person creating a CRT, like an entity, an LLC, a trust, we cannot tie it to someone else's lifetime. So there, we're going to be limited to that 20-year term. But in terms of individuals, it can be anyone. Heidi, how does the CRT get funded via testamentary trust? So the way that the trust is written, we're using the trust or the will. So it's everything becomes the way that the trust is drafted is a CRT will have what's called an effective date. So the CRT is effective, and then we'll define that date. And the way that is defined is when the CRT receives its funding. And if the CRT is funded by the IRA, of course, upon the IRA owner's death. So once Andy creates the CRT, we're going to go to whoever the custodian of the IRA is, the financial institution where the IRA is invested, and we're going to do a change of beneficiary. We're going to change the beneficiary of the IRA upon the IRA owner's death to this trust. And so this trust, which can be adjusted during our remaining lifetimes, because until that effective date, it's not an irrevocable CRT. But on the effective date, when the trust takes in the assets from the IRA, that's the effective date of the trust. At that point, it's irrevocable, and that's when the trust is actually funded. So that's how we're actually funding the trust. We have to file that beneficiary change, of course, but it's going to be part of whoever's helping you create this trust is going to help you with that. we could create the trust. We can't forget to do that because then defeats the purpose. We have to go to the custodian and make sure they all have a simple designation, a change of beneficiary form that we're going to fill out, and we're going to name the trustee and that trust name as the beneficiary of the IRA. That's the way the funding mechanism actually works. Another question about, yeah, so I should have hit on this earlier. Most of the time it is kids, grandkids, family, nieces, nephews, but it can be anyone. Anyone who's alive when the trust is created. We can't name, we're working with a client up in Minneapolis. He wanted to name his, I think it was his grandson was not married yet, and he wanted to name the future, not even engaged, whoever that grandson happened to marry. He said, well, she's probably alive now. Well, yeah, I would assume so. But if they're not known, they have to be known. So we can't name, for example, the future spouse of a grandchild. They have to be named inside of the trust instrument. So Don asked, how do the admin fees work? Typically, you shouldn't be looking at a percentage. A percentage, that's how an investment advisor will typically invoice. You should typically be looking at a fixed fee for trust administration. As I mentioned earlier, it's going to be right in the $2,500 range for the annual administration. Our fee schedule, we work with trusts that are up into 100 million plus CRTs. We cap our fee at 10,000. So we move from 2,500 to 10,000 at $1 per 1,000 in trust administration. But typically, you shouldn't be paying a percentage like an investment advisor does, because as trusts get large, the fee is just, that's not cost effective. So most of the time you're going to be looking at a fixed fee for the administration of the trust, not a percentage. In terms of course, you're going to need Andy, your attorney, to help get the CRT in place. Once that CRT is in place, you have your administrator. The administrator's handling all the compliance, the tax return, the annual filings for the CRT. If we're using a NIMCRUT with an LLC, those filings, and then you have your investment advisor. So outside of that administrator, you're someone to manage the assets, which would usually just be your own investment advisor. Those are the only professionals you would need in terms of keeping the CRT maintained and keeping its tax exempt status. Okay, so I think that's, again, if you have any other questions, here's my contact information, but just reach out to Andy, let him know. Be happy to answer as many questions as anyone has, and put together that illustration that we saw for our family B. Obviously happy to put together an illustration for you as well. So don't hesitate to reach out as questions come up.
Well, thank you, Evan, so much. This was extremely informational, and hopefully everybody on this webinar learned something new, and appreciate you being a part of this.
Hey, my pleasure. Thank you for the opportunity. Hope everyone has a great rest of the day, rest of the week, and hopefully we'll hear from you sometime soon.
Okay, thank you.
Bye-bye.
Bye.